to, okay, well, again, welcome everybody to this quarterly Zoom call. For those of you who don't know me, my name is Peter Havens, and I'm pleased to be the chairman of Baldwin. And along with me today is Richard May, founder of RKM, and we're going to have a bit of a conversation. But before we get into that conversation, our associate Christy McCloy is going to sort of give us all the rules of the road. That way we make this as efficient as possible. So Christy?
You're muted, Chrissy.
Is that better? Can you hear me now? I'm just going to share my screen. Give me one moment. Okay. Let's get this going. All right. So we're just going to go over a couple of things as the intro to our quarterly Zoom panel discussion. Here, the title obviously is this a bubble? Is this the top? This is in reference to just our first quarter findings between Peter and Richard. We are going to ask that everybody put yourself on mute if you are not a presenter, a speaker. You will have a chance to ask questions at the end, to do a Q&A. At that point, we'll have you unmute yourself, ask your question, and then just keep yourself on mute. This just minimizes background noise so that when people are talking, we don't have background noise that's coming over everybody speaking. If you have a question when we get to the Q&A section, I'm just going to show you how to raise your hand and use the raise your hand feature. In Zoom itself, if you go down to the bottom, there's a little reactions button. And then if you hover over that button, this menu will pop open and you'll see a raise hand feature. That will put you in the queue. I will see that, and then we will go in order of those raised hands. And then I will say your name, ask you to unmute yourself, ask your question. When you're done with your question, please just remute yourself. And then you can also lower your hand by doing the exact same thing. Under reaction, lower hand, and that will take you out of the queue. You can also, if you are joined by phone, you can dial *9 on your phone to be added to the queue. I will unmute you, instruct you to ask your questions, and then you can dial *9 again to take yourself out of the queue. That is the basics of the rules of the road. We are also using the chat feature. So if you'd rather just type in a question into the chat box, I will receive that question and I will jump in with the questions for Peter and Richard at any time. Okay. And we are good to go.
And this is also being recorded, is it not, Chrissy?
It is also being recorded. At the end of today's session, a link will go out in an email tomorrow that people can rewatch. And then we will also have it posted up on the website by the end of day tomorrow.
Okay, great. So let's get going. So, Richard, what do you think? You think we're in a bubble? Do you think this is the top? We've had bubbles in the past, like the tulip bubble, the South Sea bubble, some, the .com bubble, and some would say maybe Bitcoin's in a bubble. What do you think? You think we're in that territory?
Well, Peter, you just took 4 of my talking points away from me, but I'll still elaborate on them anyway. Just the fact that people are talking or asking questions like this, is this a bubble? Is this where we're about to enter a bubble? Means that there's a lot of anxiety, I think, about where the market is, the valuations. We've made some sudden gains, once the market turned up in 2023 into 24. And you remember the comments back by former Fed Chairman Bernanke back in the day. No, it wasn't Bernanke, it was Greenspan, that before the .com bubble was talking about irrational exuberance. And I must characterize that most bubbles do involve an element of irrationality. Clearly, a valuation gets carried up way above what it should be in ordinary circumstances. And I guess the question is, are we even remotely close to bubble territory now. Comparing it back to, the tulip bubble was back in 1634. It really was before there was any, really established financial store of value. So the tulip bulb became, for some reason, a store of value. And between 1634 and 1637, the value of a tulip bulb went from 1 guilder to 60 guilders before it crashed to less than 1 guilder. That took place over a 3-year period. First, the smart money came in, then the institutional money came in, and finally the general public came in. And when the general public comes in, that's when it carries up to irrational levels. So the tulip bulb obviously crashed. The South Sea bubble, which happened in England in the 1720s, you may remember that someone fairly famous for his discovery of gravity, Sir Isaac Newton, actually lost most of his net worth by investing in the South Sea Company. And when it dropped from £1,000 a share to £100 a share, he lost most of his net worth and discovered the hard way the meaning of gravity. The more recent examples, of course, the dot-com bubble, we saw the NASDAQ reach unsustainable levels. Right coming into the pandemic, we saw Bitcoin reach unsustainable levels. And, the crashes there were a little bit different than these tulip bulb crashes. The NASDAQ actually lost pretty close to 85% of its value and took 15 years for really some of that class of stocks to regain back to where it had been before. The dot-com affected a lot because, clearly there were a lot of mainstream investors that were caught up in the euphoria. The Bitcoin bubble, a little bit less so because it was pretty much a marginal event. So the Bitcoin had its mini crash and it didn't really affect the market. The dot-com crash really did. So it'd be a concern today if we were having a stock bubble moving up to the point that, it might be anticipatory of a crash. Every measure of overvaluation may be at the top of a valuation, but there's very little evidence of truly overvaluation. There's no evidence of, or very little evidence of euphoria. And basically, perhaps there's a level of irrationality in some of the investing that's been done, but I don't think we're even close. The fact that money is still coming in fairly robustly and kind of intelligently gives me reassurance that we're not in a bubble. The Luthol Group, which is a tactical investor that we follow very closely, has studied this very, very closely. And they are concluding that even though the market is what they call stubbornly high and kind of dangerously so, especially with the Magnificent Seven, they conclude that any push higher might take us into the very beginning of bubble territory. But as many know, and we talked about it earlier, a bubble can last, an overvaluation can last for years, and it theoretically could. But their conclusion is we are not near a bubble territory. And I'd be interested in, Peter, in your thoughts about it as well.
Well, I would concur. In fact, let me bring up a couple of charts that may be of some help in discussing this. So, Chrissy, can we go to chart number 1, please? So this looks at the S&P 500 index at various inflection points, and you'll see on the far left-hand side the March 24, 2000 peak. Now that was the dot-com peak about which Richard just spoke. And you can see there that the index was at, this is the S&P that is, was at 1527. The PE ratio, that's the price earnings ratio at that peak. So this is a measurement of value that we very often use when gauging markets, was at 25.2 times, and the dividend yield on the index at that point was 1.4%. And this was in an environment where the 10-year Treasury, it was at 6.2%. Well, today, as a comparison, the forward PE of the S&P 500 is at 21 times. So it's about 17% cheaper than that peak in March of 2000. We also have a dividend yield of 1.4%, and the Treasury yield is around 4%. So we've got lower interest rates. We've got the same dividend yield that we had back in 2000, but we're trading at a much lower PE ratio, which means that certainly we're not going to say that this market is inexpensive, but we're not in the same sort of bubble territory as there was back in March of 2000. Why don't we go to the next, we'll go to chart 2, please, Chrissy. Let's take a look at it another way. So Richard mentioned the Magnificent Seven. And the Magnificent Seven is a group of stocks that have rocketed in the recent markets. And you'll see a number of them on this chart here. So this chart takes a look at the most expensive stocks back in 1972, which was an era when we had one decision stocks. You bought them, you owned them, you forgot about it because they were just going to go to the moon. And this particular market subsequently crashed. And you'll see some names there like Kresge. Kresge was trading in excess of 50 times earnings. That was more recently known as Kmart. And you have Eastman Kodak, which was trading around 50 times earnings. And then you see the sort of just below the halfway mark, the Nifty 50 median. And so there were, roughly around 50 stocks, which were these hyper growth stocks that, people said, well, one decision stocks, we own them. Well, below the Nifty 50 median, you'll see a list of Amazon, Microsoft, Nvidia, Meta, which is Facebook, and Alphabet, which is Google. Those are 5 of the Magnificent Seven. And so you can see that they trade for lower PE ratios than the median Nifty 50 stock back in 1972. So again, I think this is just nothing more than another marker of, yeah, we're expensive, but we're not as expensive as we have been in the past. We're not as expensive then, and we're certainly not beyond it. So there is, if you will, still some value in these markets. So we are believers. There are 2 ways, I suppose you could say, that this could end. One way would be everything crashes and everything comes down, bubble pops, and stock prices go much lower. Another way this can end is that the leadership in the market, which has been narrowly led, if you will, by the Magnificent Seven, if that leadership broadens out. In other words, it starts to include other names. So as opposed to having just 7 out of the S&P 500 lead, maybe we get 200 stocks out of the S&P 500 which achieve higher prices and new highs. So Chrissy, why don't we go to the next slide 3. This is a chart provided to us by Barclays, which is demonstrating exactly that point. You see in the far right-hand side, this is a measurement of the S&P 500 leadership beginning to broaden out. In other words, stocks that are not included in the Magnificent Seven, more names are achieving new highs. And so this would be the happy result, if you will, or the happier result. As opposed to the market crashing, we have the leadership broadening out and technicians, which is a group of analysts, if you will, that intently follow the price machinations of various stocks in the market. They are heartened when they see the leadership broaden out and more stocks become players in the leadership. So a question that also gets asked at these times when we get to so-called market tops, is it smart to buy at the top? People are always reluctant to buy at the top because they automatically think, well, the next move is going to be down. And I'm going to look like a sucker because what I've done is I bought at the top as opposed to buying at the bottom. Nobody wants to buy at the top. Chrissy, go back to chart number 1, if you would, please. Okay, so as we take a look at this chart, you can see that between March of 2000, March 24 of 2000, when there was a very meaningful market top, when the S&P 500 reached 1527, people who were buying at that price obviously were probably concerned, why am I buying at the top? And then the market did go down. But look to the far right and look where we ended up December of 2023, and we're even higher now. We're over 5,000 on the S&P 500 now. You can see that obviously we've achieved a new market top, a significantly higher market top. And in between those 2 points, there have been several, quite a few, many market tops. So the point of this is nothing more than a good investor, a wise investor, number one, has a long-term viewpoint with regard to investing. And number two, is a disciplined investor. Shouldn't be concerned about so-called market tops because I, quite frankly, don't know where the market top really is. Capitalism, as long as you believe in capitalism, as long as you believe our economy is going to continue to grow, I dare say there will be more market tops post your purchase of any particular security. So I wouldn't be concerned about buying at the top.
So Peter, if I may add just a couple of comments to that.
Absolutely.
It's interesting that Polaroid was on your list of Nifty 50. And I think Polaroid illustrates a point. In 1972, Polaroid was one of the most highly valued of the Nifty 50 stocks. And I happened to, just around 1972, was at an event up in Massachusetts where the CEO of Polaroid was attending. And he was, of course, the darling of the event. Everybody was gathered around him because he was running one of the most popular companies in the country. And somebody asked him, he said, don't you think the Polaroid stock's sort of way beyond where it should be? And he said, well, it might be, but what am I supposed to do about it? It's interesting that within 10 years, Polaroid was out of business. Some of these fantastic companies, the NVIDIAs and the Teslas and the Microsofts, they're only as good as the next generation of leaders coming along behind them. General Electric was the darling for the 50s and the 60s and the 70s and ran into a rough patch when their chairman, Jack Welch, left. So the market can be at a top, but it's saved by the fact that with the Magnificent Seven, there are 483 issues that are not overvalued right now. And it shows the benefits of diversification. The other the other comment I wanted to make is the question, is there a bubble, might encourage somebody to say, if it's a bubble, maybe I should be selling. And since I think we both agree it's not a bubble, it could get to be one, but there'd be no reason to be reducing your positions because of fear of something bursting. The other question is this a top of the market? The question's more appropriately, should you refrain from buying? And Peter just answered that question by saying, even if it's a top, there are going to be many, many tops on beyond this. And presumably the tops are higher highs and higher lows, and that you'll continue to make a decent return by investing in the market. What it might mean is an investment now might achieve a return that's not quite as robust as the returns have been for the last 50 years or the last 70 years. And there's some statistics on that I can share if you think the time is appropriate, Peter.
Sure, why don't you go ahead?
Yeah, Luthold, the same outfit that basically did the treatise on the bubble, also did a analysis on what kind of returns we might expect from a balanced portfolio of U.S. stocks over the next 10 years. So they looked back from 1926 through March of 2024, so it's almost a 100-year period. And the stock market on average, some good years, bad years, but averaged about 10.4%. Then they looked at the period from 1957, so a little bit of a more modern period, from 1957 when the S&P 500 was first established through March of 2024, and the return was 10.5%. So this is pretty remarkable over the course of almost 100 years, and the last 65 years, the returns have been remarkably consistent at a pretty robust 10.5% return. So they projected what was needed to achieve a 10.5% return going forward to the next 10 years. And they concluded that rather than a reversion to mean, if there were a reversion to peak, we could do it. And what they mean by that is we have the best possible sales growth that we've had over the last 20 years. And we had the best possible operating earnings experience, meaning profitability on sales, that was experienced over the last 20 years. And if we had the highest price earning multiple that's been achieved over the last 20 years, and we maintained the same dividend that we've had over the last 5 or 10 years, we could achieve that 10.5% return. This was a study done, Luthold is in Minneapolis. So they mentioned Lake Wobegon, which, as many of you know, Lake Wobegon is where everyone is above average. So the these kind of assumptions to get the best possible sales growth, best possible return, the best possible price earnings multiple is almost like a fantasy. They did it then to a reversion to average sale growth over the last 25 years, average operating efficiency and earnings, an average price earnings multiple, and average dividend growth. And they got a much more modest, even a little depressing, 3.1% a year for the next 10 years. So I think we can safely say the return's going to be somewhere between 3.1 and 10.5% during the next 10 years. I figure we could take an average of the two, and it comes down to about 6.5%, which is a pretty good assumption. So let's plan on a 6% average return over the next decade of an investment in a common stock portfolio. Is that defensible, Peter?
I think it's quite defensible. Yes. And it begs the question, well, okay, where should one look in these markets to get a defensible rate of return, and maybe even a little bit better than a defensible rate of return? Because as we've said, there have been some stocks, such as the Magnificent Seven, which have rocketed forward. Now all these companies in the Magnificent Seven have got what analysts would describe today as very, very bright futures, because they're largely involved in artificial intelligence, and everybody thinks artificial intelligence has got a brilliant future. And so it may well have a brilliant future, and we're all going to be beneficiaries of that future on a going forward basis. But obviously, when you're buying stocks which have rocketed forward, and they are by most measures a wee bit on the expensive side, your risk goes up. That you're not going to achieve the rate of return that you hope to achieve, or the rate of return that you probably got a better chance of achieving if you buy cheaper stocks, simply because they've got more room to run on the upside. So where else might one think about investing money? And let's just say as the first sieve, where are stocks? Where are the stocks that haven't moved so much? Well, again, you had the Magnificent Seven in the U.S. market, run ahead. You've got 493 other stocks in the S&P 500, which have not rocketed forward as much, and they trade at a significant PE discount, price earnings ratio discount, to the Magnificent Seven. They're trading at about 18 times earnings, forward earnings, and that's versus the Magnificent Seven, which are trading at about 28 times earnings. So there would be a good starting point. You've got quite a few stocks in there, and quite a few stocks in there which are trading at even more significant discounts. They're not all trading at 18 times earnings. Quite a few of them are trading at much cheaper PE ratios. But let's look further afield, because as investors, the world is our oyster. We can go anywhere and invest our money. There are opportunities near and far afield. So, Chrissy, let's go to the next chart if we can, please. Nope. This is now chart 4. Okay, great. So this is looking at the MSCI All Country World Index ex-US. In other words, these are international markets all over the world. Now, when I first got into the business, investing overseas was considered very avant-garde, very risky. Not a lot of people did it. It was basically buy American. But in fact, now there's not a top research house on the street that doesn't have an extensive international research effort. So these are a lot of international names, like Nestle, like Airbus, like Lind, like Shell, like BP, are all well researched by Wall Street houses. International names have not participated to the same extent as the American market in the progress that the American market has made. And that would be the subject of an entirely separate session. But let's just take my word for it. They haven't participated. And here's one indicator of this, because you can see there that these are the PE ratios of the S&P 500 versus the All Country World Index ex the US. And international stocks are trading at 2, you can see the bottom line there, 2 standard deviations, which is a negative 34%. 2 standard deviations cheap to the US market. So they're trading at 12.9 times earnings versus about 20, 21 times earnings. Chrissy, can you go to the next slide, please? And in fact, you can buy those stocks far less expensively and get a higher yield on them. So the average yield on the All Country World Index is 1.7%. That's 2 standard deviations higher than the 1.4% yield on the S&P 500. So you can get more dividend income for a cheaper price if you went internationally. And that's just one possible opportunity. There are other ways of investing money where you can, let's say, uh, tactically sidestep if there is any sort of correction.
If I may, Peter,
Absolutely.
Chrissy, could you put that BlackRock slide up, which I think is the next one? This was BlackRock, which many of you may know is the largest asset manager in the U.S., larger than Vanguard, Fidelity, or I think or Morgan Stanley. Stuck their neck out a little bit by giving us their projections for 5, 10, and 20-year expected returns of a variety of asset classes. And just coming down from the top, reading over to the right, the 5-year expectations for government bonds, 3.6%, not terribly surprising because we're that and higher right now. Fixed income long government bonds, a little bit less so because I think they believe inflation is probably going to be challenging. The third line is really indicative of what Peter's been talking about. Ex-US equities, which includes Europe, Asia, South America, every place that there's a stock market, India. The average they expect over the next 5 years is 8.8%, 10 years 8.6%, 20 years 8.1%, with volatility pretty close to what the volatility in the U.S. is. Go down to the next to the bottom line, and you'll see U.S. equities woefully behind, with a 4% expected rate of return for the next 5 years, 4.8% over the next 10. And it takes up to 20 years for the U.S. equities to start to catch up with some of their international peers. So this illustrates that they may be wrong, clearly, but they manage enough money that what they do and how they invest will, to a certain extent, help determine how some of these things work out. Notice in the middle, we have emerging markets actually underperforming in this chart, underperforming the ex-US equities. US real estate, which is the fourth line, not surprisingly, more modest returns going forward. And infrastructure, not on this chart, is infrastructure, which they expect to get returns in the 8 and 9% levels as well. So as Peter said, there are lots of places to invest that aren't just straight US stocks. So not to pick on the S&P 500 index, but this would probably argue that over the next 10 years, you'd be probably doing well to get a 5% return from them. And that's pretty much consistent with what Luthold's saying as well.
So let me give you, go ahead, Richard.
I was just going to raise the last issue that we wanted to talk. We've been talking for about 30 minutes. We wanted to at least address inflation as a topic and how that might affect investment performance as well as how our clients are invested.
Well, I guess you and I are old enough to remember earlier years when this country really did have a problem with inflation. And that was back in the 70s. And remember, we looked at when markets in the 70s rolled over and declined rather considerably, the Nifty 50. And that was at a time when this country had very severe inflation, and it seemed like it was embedded in our economic system. And the only way it got broken was when Paul Volcker became the chairman of the Fed, the Federal Reserve, and decided he was going to put the country into a near depression to break the back of inflation. That was a very painful time. And at that time, not only, well, the way to combat inflation was to raise interest rates. And Mr. Volcker raised interest rates rather substantially. I mean, today we see headlines in papers, and they talk about interest rates being at their peak, over the last 20 years. And, they're at, the Fed funds rate is at 5.25 to 5.5%. And the 10-year treasury's got a 4 handle on it. I remember mortgage rates being 13-14%. Mortgage rates today are at 7, and people are groaning about that. But that's not the way it has been in this country. Now, I don't think we believe at all that we're going to get back to those sorts of hyperinflation numbers. And we don't think that interest rates are going to have to go that high at all. In fact, for the foreseeable future, we may have seen the peak in interest rates. The Fed has stopped raising interest rates. They stopped it last, I think it was July, they stopped raising interest rates. We've had several months now of basically flat interest rates. There's been a fair amount of jawboning on the part of the Fed to try and restrain bond market enthusiasts and stock market enthusiasts, but they've not increased interest rates. And in fact, all the discussion as far as the future direction of interest rates has been, they always put a caveat, it's always data driven, but they have strongly indicated that the direction in which interest rates are going to go in the future is going to be down. So we had a spate of inflation. It was certainly painful, especially for those who've never really experienced any inflation. I heard a statistic the other day by a fellow, Steve Ratner, who manages money for Michael Bloomberg. And Ratner said that 2/3 of the American population in their lifetime had never experienced inflation. Now, I found that to be an amazing statistic. I don't know that it's entirely accurate. There might have been a little bit of TV hyperbole attached to it. But let's just say a very significant part of our population has never experienced the inflation that we had back in the 70s in this country. And so while I sit back and say, I don't know what these people are talking about, interest rates at 7%, what does that mean? I've seen interest rates at 15%, and I've seen inflation at 12%. And what are these people talking about? They're all at, and not inflation at 12% for like a couple of months. It was a couple of years we had severe inflation. So people are wringing their hands about the experience they had. And maybe it's just simply because, my misunderstanding of why they're reacting the way they're reacting is because they've never seen it. I thought it was a reasonable point. What do you think?
And to add to that, I think the average person, and this is consistent with 2/3 of the people never experiencing inflation before, I think people think that if inflation goes down, prices go back down. In other words, they expect the dozen eggs to go back to $1 a dozen, rather than just the rate of increase in the price leveling out.
Right.
And I think that's why people are so angry right now about the economy and about prices and inflation, is they see it every day. They drive by the gas station, and more importantly, they see it on the every time they go to the supermarket. They look at what they used to buy with $100 and what they could buy with $100 now, and it's a comparison. So the fact that inflation will drop from, let's say, 5% to 3% just means that the rate of increase will diminish, not the
slow down.
Yeah, exactly.
Yeah. I think there's no question that with the increased globalization of the world's economy, there were a lot more levers to pull to dampen inflation. If prices went up too high, in other words, if I'm a manufacturer and I would source my material for dresses in Indonesia, and then price went up too much in Indonesia, then I would call on manufacturers in Vietnam, China, uh, Laos, etc., Bangladesh, etc. And that was a great dampener on pricing. Pricing and with the internet, price discovery was so much easier. You could go on the internet and find out where the cheapest price was for any particular item. Whereas before we had the internet, you might write 1,000 letters and find out where it's like, but nobody did that. They basically dealt locally where they could see where prices were. But that was inefficient. Certainly with, I think, changes in politics, um, we're probably not going to go back to inflation being less than 1% in this country. In a certain way, I'm not sure that that's a bad thing, because for about a decade, we were fighting disinflation. The Fed was fighting disinflation. And they really don't have a very good toolkit to do that. They know how to fight inflation. They're well experienced at doing that. But disinflation, they don't have all the tools they need. So they were there to help pump up the economy. That's why we had quantitative easing. That's why we had interest rates so low. But I think as we go forward, if we have inflation, and I'm not even sure inflation is going to get to sub 2%. Inflation may be between 2 and 3%. And the Fed may say, well, that's good enough. It's got a 2 handle on it. We said it had to get to 2. It's gotten to 2. Well, maybe it's 240 and it's not 2, but it's close enough. And we'll start to lower interest rates. I think if they do that, they get there, then I think they're going to have enough of an excuse to lower interest rates, and that will be a support for certainly the bond market, and it will also be a support for the stock market, and it will be support for financial markets around the world.
Exactly, and during the course of the last 100 years, a balanced portfolio, meaning some in stocks, some in bonds, some international, achieved a return between 3 and 5% better than the rate of inflation. So in effect, if we end up with 2.5 or 3% inflation, and that rule holds true for that 3 to 5% above inflation, we're talking about 5.5 to say 7.5, 8% return from a balanced portfolio, and that relationship should continue well into the 21st century. I don't see any reason why any, short of a world war or something like that, that would upset that very long established relationship. And the 20th century had 2 world wars, a Great Depression, and lots of other interesting things.
Yes, and we still managed to get that rate of growth that you talked about earlier. So it's the house bet. If you believe in capitalism in our system, the stock market goes up about 70% of the time. That's the house bet. And I've always believed it's smart to bet with the house. Don't bet against the house. I've known too many people that tried to bet against the house and they lost a lot of money. So are we ready for questions? Chrissy, do we have any questions?
Not at the moment, but I will just remind, there is one that did come through. But I just want to remind everybody to use the raise your hand feature. If you hover over the reactions button and click on raise your hand, if you're a part of the Zoom here, if you're joining by phone, you can hit *9 and it will alert me that you're ready for a question. The first question we have in there is on the thought that international equity may have twice the return of US over 5, 10, 15 years. How does currency change and risk affect prospects?
That's a great, you first, Peter.
Okay. Well, certainly currency will affect your returns. having a weak dollar will enhance your international rates of return because you'll be taking a stock which has gone up in value or a bond that's gone up in value, and when you sell it, you will have bought it in euros, say, Japanese yen, and when you sell it, you'll be converting it back into a cheaper dollar. You'll get more dollars for the euro, for every unit of euro or every unit of yen or whatever the foreign currency is. So that will add a bit of rocket fuel to the returns that you're getting on the security. Now, if you invest in a period of time, if you invest internationally in a period of time where the dollar is strong, that will detract from your international returns because you will have bought a foreign currency, and over the period of your holding, the dollar goes up. That will, when you convert back into the dollar, that will hurt your returns. And in fact, it could erase your returns. If the dollar has gone up more, the dollar goes up 10%, and the stock has only gone up 9%, you will have lost 1%. And conversely, if the dollar goes down 10% and your foreign stock has gone up 10%, you will not just earn 10% on the stock, you're going to get an extra 10% on the currency, and so you will have earned 20%.
Peter, case in point is the Japanese market right now. I think that's the best performing market in the world. It's up like 15% so far this year.
Correct.
But their currency's down substantially against the dollar. So an American investor that invested in Japan in January made 15% until they tried to pull their money back. They realized the yens that they made were not worth as much as they were when they put them in.
Yeah, they still made money, but they haven't made as much money. I
Exactly.
think the yen is down 7 or 8% versus the dollar so far this year. So while you may be up 15%, you lost 8%, so you're up 8% on the currency. So net you're up about 7%.
Exactly. And some funds, some mutual funds or exchange traded funds hedge their currency investments. They might have gone into Japan, realized that there was some softness in the Japanese currency, and made a outside their normal bet that the dollar would go up against the yen, and that mitigates the loss that they might have had with the currency exchange. So that's something that an international investor, especially at the fund level, can do that's protecting from that eventually. I know there was a question, one that I saw popped up about what's an emerging market.
Mhm.
Let me just say quickly that we kind of look at three different kinds of markets. There's developed markets, which would be Western Europe, US, Canada, and Japan. And then the emerging markets generally, China, I think, still is considered an emerging market. Brazil, Russia, Mexico, I think, is now considered an emerging market. And the third category is the frontier market, which is basically those that don't have a very well-developed stock market or rule of law or economic system that are trying to make it to emerging. Is that a fair definition, Peter?
Yeah, I think so. I mean, the surprising thing is that China is still considered an emerging market. It's the second largest economy in the world, and it's considered still an emerging market. But don't anybody ask why is that, because quite frankly, nobody knows.
We still don't have anybody in the queue, but there is a question. It says, we've never had a threat to democracy in the US like we do now with partisanship, infighting, and the prospect of a Trump election. What is the view of market if Trump gets elected, both short-term and long-term?
I'll let you handle that one, Richard.
Thanks, Peter. I would only say, without getting into politics, historically, elections in the US have been noise outside of what the stock market has done, but they're two times in the last century where election had real consequences. And one of them was in 1932 when the kind of free range capitalism that was going on from the 1890s through the 1920s was halted, and government, instead of being an innocent bystander, government sort of took a more prominent role in running the economy. And then we did the reverse. We flipped in 1980 when Ronald Reagan was elected, and the government, remember his the great quote, what he dreaded was the comment, "I'm from the government and I'm here to help." And the role of the government sort of between 1980 and really the end of the last decade was pretty much had reverted to its bystander role. I think the election this year might be one of those elections that determines the direction we're going. I'm not going further than that.
That's a smart move.
All right, so I don't think we have any other questions.
Nothing more?
Nothing more.
Any concluding
Okay.
remarks, Peter?
Well, Richard and I thank you all very much for your time. We hope you found this to be of some help, or at least interesting. And we'll be back next quarter with another one of our quarterly Zoom meetings. Until then, thank you very much for your time and your attention. And Richard, any remarks from you?
No, just thank you, Peter. Thanks for making this forum possible. And we, in the past, sometimes we've had guest speakers when the topic demands it. The topic goes beyond our expertise. We had a very nice speaker from the former ambassador to Vietnam that spoke at one of our sessions, a Tulane University professor that spoke at another, and a doctor from Mainline Hospital that spoke at another. And they were very well received and I think quite enjoyable.
And we'll do that again. All right. Well, if there's nothing else, thank you all very much. Take care. Bye-bye.
Thank you.